Tracking your KPIs. In this video, we are going to talk about what are KPIs, what to track, and the compliance department. Okay, so what are KPIs? So KPI stands for Key Performance Indicator. KPIs measures your performance against key objectives. Okay, so basically KPIs are used by high-end organizations. They use KPIs to track their success at reaching targets. So a lot of big companies use KPIs to track their progress, track what needs to be done to get to a certain goal. Us as traders are going to take that concept and apply it to our trading world. We are going to apply KPIs to our trading world. Now, obviously, the KPIs companies use and the KPIs we're going to use are going to be completely different, but the concept is the same. We are both on the same road, on trying to achieve a massive amount of success, and the only way we can reach a level of success is by measuring our performance and measuring what needs to be improved, what needs to be refined, and kind of take it from there. Now, how does a KPI system work? So a KPI system works something like this. Let's say your goal is to identify what is the biggest reason for most of your losses, right? So you go through your trading journal, you go through all your trades, and you see that you have a lot of losses, right? Now, the question you may have is, all right, I have a lot of losses, but what is the biggest reason that I'm losing a lot of money? Or what is the biggest reason for all of these losses? How can I actually fix it? How can I get better? Right? So that's where the KPI kicks in. So in the KPI, you basically track the required data needed, right? So for every objective, there's different amount of data that you're going to have to focus on, that you're going to have to narrow down on to really understand what the root cause is. So when you track the data, you look at what the biggest reason for your losses are. Now, when you do that, you end up realizing that most of your losses come from either emotional trading, such as you chasing, or most of your losses are on Fridays or when you try to scalp. Let's say you have about 20 losing trades in the past month, right? So when you track them, and I'll show you the journaling process and tracking them in a bit, but when you track all of these 20 trades, once again, the whole idea comes down to the metric, okay? Now, when you're tracking, obviously you have to really go in depth and track a lot of important concepts. You can't just track, your entry price and exit price. You also have to track your reasoning, and you have to go in depth, which I'll show you guys. Now, when you track these 20 trades and you're like, okay, I lost money on all 20 trades. Now, your job is going to be to go back and review it. That's where your compliance department kicks in, right? So in that compliance department, you go through each trade and you start evaluating certain rows. You start evaluating, okay, I noticed there's a pattern. The pattern I see is out of these 20 trades, about 16 of them, my reasoning for getting in was because, let's say I saw it in a group chat, or because I saw other people trading it, or because I was trying to scalp. I was trying to get in a minute and get out. That doesn't work for me. I'm very bad at executing. So I realized out of these 20 trades, 17 of them were the same exact reason. Now, what do I have to do from there? I have identified the problem, which is good. Now, my next step, as I just showed you guys, is to fix your mistake and then make adjustments. So you make adjustments, you either don't scalp, or you either size down, or you make proper adjustments to work on this main reason for your losses. So that's the whole idea of having a KPI system. And that's the whole idea of having a tracking system that tracks each one of your trades. Now the question is, what should I trade? What should I track? Everyone's like, okay, I got it. What do I track? Now, there's two parts of trading that you have to track, and I think a lot of people tend to miss this. The first side is the emotional side. Very important to track this as well. And then obviously the other side, which everyone kind of usually tracks, the people that do track, is the trading side. So you have two sides, okay? There's the, once again, trading side, and you have the emotional side. You want to track both, right? Obviously you want to track the actual information such as where you got in, right? Where you got out, why you got in, why you got out, based on trading terminology. And then also, this is where you have to become super self-aware. You have to look into your emotional side, okay? Why did I get in? Why did I get out based off emotions, right? So for example, you might say, that you got out of a trade because you thought it was going to go down. Okay? But when you dig down a little bit deeper, you start realizing the reason you got out at that moment was because you maybe saw a red candle, a red 5-minute, a red 15-minute, a red 30-minute candle. That's why you maybe got out. You maybe got out because you saw green, you saw you were up on the trade, and you ended up getting out because of emotions, and you did not want to see a red day. So there's a lot of reasons, and obviously when you track the proper way, these reasonings start popping out. Okay. Now, obviously, if there's one trade, let's say you have 50 trades. Out of those 50 trades, obviously, if one of the times you exited because you saw a red candle, let's say, then obviously that's not a big deal. But now let's say out of 50 trades, when you look at your exit points, you realize that 27 times you exited because you saw a red candle. So, and whenever you see a 5-minute red candle, you panic, right? You just clearly panic on that trade. Now, when you realize that, you're like, wow, 27 times I saw a 5-minute candle being red and I panicked. Okay, cool. Maybe it was a good thing, maybe it was a bad thing. Now, that's where the whole KPI system kicks in, because now your job is to go back to these 27 trades and say, okay, what happened? Right? What happened? I saw a red candle, I exited. Maybe I made money, maybe I didn't, whatever the case is. But what happened here? So you go and you start realizing that out of those 27 trades, about 19 of them kept going higher. That red candle was just a fake out. So basically, if you did not let your emotions get in the way because you saw a red candle, you saw your profits going down, and you held on to those trades, instead of you making an overall $5,000, you would have maybe made, I don't know, like let's say 12, right? So when you start tracking, you start realizing these small things, and you're like, wow, this small little mistake or this small little idea of trading that I understand completely wrong is really messing with me. Another thing, like I mentioned before, is you'll also notice on the emotional side, it goes deeper, right? Let's say you work an overnight shift on Wednesday, right? Wednesday, you work somewhere, you get off work at 5 a.m., right? And then you get off, you take a nap for 1 hour, 2 hours, and you start trading at, let's say, 7 a.m. You get in front of your computer at 7 a.m. Now, when you start tracking, you start realizing that usually on Wednesdays, I'm red. Why on Wednesdays am I red? Now, that's your job to go deeper and really understand, right, everything behind the scenes, right? It could be, like I mentioned before, it doesn't have to just be the trading side. It also has to be your personal life. What's happening on Wednesday night? What's happening on Wednesday itself? What's happening that week, right? So when you start tracking that, you're like, oh man, I made terrible trades the past 4 Wednesdays because I was working a late shift and I'm coming home at 5 a.m. I'm all over the place and I'm trading just to trade. Why is that happening? Okay, that's happening because I'm obviously trying to overtrade. I'm obviously trying to make money, right, when there's no trades and my headspace is not at its full capacity. And you start realizing that only when you start tracking. Another common mistake that some people make on the emotional side, and this is where a lot of people get blinded by. This is not the area people get blinded by. They get blinded by the emotional side. Another thing that a lot of people, kind of overlook is the timing, right? So for example, let's say in the past month, you've had 30 losing trades. Like, wow, I've had 30 losing trades. I'm down $5,000 for the month. Where did everything go wrong? A lot of people tend to look at the trading side, but what they need to look at first is this, right? Now, common mistakes I've noticed a lot of people had on this concept is when you go through these trades and you look at the time, you'll probably notice that a lot of the trades are either right on the open, right? Like the market opens and you take the trade there, or some trades are like at 11 a.m., 12 p.m., like basically 4 or 5 hours after the market opens, right? So by then, obviously the market dries down, everything becomes harder to trade. Now, obviously, if you're trading on the open, you're rushing. You shouldn't trade on the open. Now, obviously, if you're trading towards the end of the day, towards 12 p.m., 1 p.m., depending on wherever you are, basically 4 or 5 hours after the market has opened, you're basically taking those trades because subconsciously you're telling yourself, hey, I've been in front of my computer for 7 hours, 5 hours, and I have not traded. And as the time builds up more and more and more and more, what you tend to do towards the end is you end up forcing trades, right? And then when you start realizing that pattern, like, wow, out of these 30 losing trades, about 25 came after 12 p.m., after 3-4 hours of the market. Let me go look at the trade again. Wow, that was a terrible trade. Why did I take this terrible trade? Oh, it makes sense now. I took this terrible trade because obviously I was sitting in front of the computer for multiple hours, and as I was sitting in front of my computer for multiple hours, I forced myself to trade because I'm like, hey, I've been here for so long, I need to take on a trade, right? And that's why when you track both of these and you're very self-aware, you're gonna start realizing these small little mistakes, and these small little mistakes compound, right? So for example, let's say you have one bad trading month, you're down 5 grand because of a very, 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 very stupid trade. A lot of very stupid trades because you're over trading, because you're sitting in front of your computer for 5 hours, and after 5 hours, you're forcing yourself to trade. Now, if that's the case, right, what tends to happen is this becomes a domino effect. You're down 5 grand 1 month, right, or 1 week, whatever. Now, obviously, your emotions go all over the place, and then that becomes a domino effect where you continuously keep increasing mistakes, you start sizing up, and your trading just starts becoming bad. That's why tracking and understanding and fixing and tuning is so important. Like, that is the most important thing, guys. Like, you need to track both sides, your emotional side, your trading side. Like, it really, really needs to be tracked to its core. Okay, now let's go over some examples of the trading side and the emotional side. So on the trading side, you look at stuff like, what setups are making you the most money? Okay, what setups are not working out? What's your start and end risk to reward ratio? How's your stop levels? How's your profit target levels? What's your winning percentage, right? On the emotional side, you'll have questions such as, how do you react when you're green or red on the trade, right? Are you able to cut losses as planned? Do you follow your setup, or do you not follow it? How do your emotions step in and play a role? Do your emotions even step in, right? And how do you feel after certain trade outcomes? So these are two sides, just a little bit of information to see where the differences kick in. So these both have to be kind of tracked. And when you track it, it's not where you're just going to plug everything into an Excel sheet. And I'm going to show you guys the Excel sheet in a bit. But it's more so you analyzing and you being so self-aware and asking yourself these questions and a lot more, right? Now, what are we going to track? So some things you're going to start tracking is obviously the date, right? The ticker symbol, the trade type, short, long, calls, puts, like what are you trading? Trade setup, are you scalping, day trading, swing trading, breakout, reversal, trending? Like what are you trading, right? Reason for trade, you have to write down your reason. Okay, I traded because there was good catalyst. I saw the market internal showing me a strong move. Whatever the case is, there needs to be a reason for your trade, right? Even if it's a bad reason, it doesn't matter. The idea of this is not to make it look all cool and fancy. The idea of this is for you to be raw, right, and transparent. Entry point and time and quantity. What point did you enter, the time you entered, and how many shares or contracts. Now, pre-trade, what's your stop area? What's your profit target area? What's your risk reward ratio, right? This is the pre-trade. Right? Like I mentioned to you guys before, when you set up your trade, there's a big disconnect on the pre-trade on what your risk reward ratio is and after trade. Like before you take the trade, your max loss might be 200, right? And your profit might be potentially 600. After you're done with the trade, you only made $100. Now, when you look at this trade, you're like, wow, I risked 200 to make 100. Did something change in the chart where it was okay for me to take 100, or did I just panic? Right? That needs to be seen. Then exit point, time, and quantity, and then that's where the aftermath part kicks in. Did you follow your plan, or did something change, and why did it change? Like, these are questions that you need to ask yourself, guys. Like, you really, really need to understand and ask yourself this on a very, very deep level. And then obviously, how are you feeling during the morning? Did you follow your morning routine? This is another question that you need to ask yourself, like, hey, was everything followed? Did you actually go and do your pre-market routine? Did you look into the market? Did you look at your levels? Did you create a plan? How did you feel? Did you just randomly wake up 2 minutes before the market opened right? Did you wake up 2 minutes before the market opened and just start trading? If that was the case, that's not good, right? And then obviously your trade rating. Like, what do you rate the trade and why? Now, this is also very important because a lot of people think that if you lose money on a trade, that trade should automatically get an F. No. There's a lot of times I personally lost money on trades, right? And I still gave it an A. Why? Because the probability of it going my direction was high. My risk to reward ratio was phenomenal. Everything was great. Just some maybe new news came out or it just didn't work out. Something that was completely out of my control. So I'm still happy with the trade. Yes, I didn't make money, but I still gave it an A or a B, right? Sometimes there's things I could do better. Sometimes some news or events come out that I have no control over. And you as a trader need to accept that and say, you know what, that's okay. It's okay for me not to make money on a trade and still give it an A if I followed my plan, if everything looked good, and kind of take everything from that perspective, okay? Now, let's jump into the trading journal. I'm gonna show you guys the trading journal. I'm gonna show you a sneak peek, and then on the next video, we're gonna break the trading journal down to its core components. All right, guys, so this is the trading journal that I was talking about. So I'm gonna give you guys a sneak peek of this journal, and in the next video, I'm going to break the full component of the journal down. My main goal is just to show you the KPIs we're tracking and what the purpose of the tracking is, right? And I'm gonna show you guys a few examples so you have a better understanding. So right here, I have a few trades. So the first trade I have, you guys can see, it's Apple. So right here, I'm putting my date, I'm putting the symbol, I'm picking if it's call options, if it's put options, am I going long, am I going short? Like what position is it, right? So for the first one, you guys can see call option. My entry time was 9:45 a.m., right? You're also putting in your entry time based on your time zone, entry price, quantity. Now right here is my pre-trade setup. Now this is very important because as you guys can see, having this setup is showing me where I actually entered, what time I entered, the quantity, and my full setup. Now based on my original setup, my stop loss was at $2, my profit target was $4. So basically I'm risking about $2,500 to make about $7,500. Now, as I've mentioned plenty of times, it looks great when it's shown like this, right? So before the trade is actually, like before you're in the trade and you're making your plan, it looks phenomenal, right? It's like, wow, I'm risking $2,500 to potentially make $7,500. That's a great trade. Now, what a lot of people, like I mentioned before in trade management, what they don't understand is that's the first stage. The idea is to be in between that stage, in between where you're holding the position and when and where you get out. So now let's move forward and see where and when we got out. So we got out the same day, 10/19 at 10:01 a.m. So we held the trade for about 16 minutes, right? And you guys can get all of this information from your broker statement, right? You can go on your whatever platform you're using, you can just download it and then look at your transactions, and it'll obviously show you what time you entered, exited, and all that good stuff, right? Now look where we exited. We exited at $2.82. Now, when we look at this trade and we go to the end result, this is what a lot of people mess up on. They go and they're like, okay, I made money. It was a winning trade. Since it was a winning trade, it's good, move on. No. Your job is to go back and evaluate. Right now, when I go back and I evaluate, I'm going to look at this and plug it in and say, okay, what happened? I wanted to sell at 4. Why did I sell at 282? Yes, I made money. That's great. But why did I sell at 282? What happened to it going at 4? Now, obviously, what I would do at this point in that is I would go back to my chart at 10:01 a.m. and I would see what the chart shows me. Now, at 10:01 a.m., maybe I panicked. Maybe there was a good reason for me to sell. Now, if there was a good reason for me to sell, maybe price action started showcasing that the play is reversing. I sold and I looked at the same stock at, let's say, 12 p.m. And I noticed that the stock went lower and lower and lower, or the option premium went lower and lower and lower. So me exiting at 282 was a good idea or a good trade. But the only way I'm going to find that out is by going back and looking at the times and looking at the stock and looking at the option, whatever the case is, and understanding that. But now let's say I go back and I look at this and I see that there was just basically a red candle, or maybe I panicked, and next thing you know, it did go to 4. Like I could have potentially made 7,500, but I panicked, right? I made an emotional trade. I was green, I made 1,500, but my original risk was 2,500. So cool, when I go to this profit and loss status, this looks amazing. This is like, wow, I made money, phenomenal. You're happy. But now when you go to the result of the trade, you're like, okay, I made 1,500, great. Green is green. But when I actually look at this trade, I was risking 2,500. Okay, that's fine. I was risking 2,500. Maybe the stock reversed. So when you go look at the stock, when you look at the option premium, and you start seeing that it didn't reverse, it just took a break and it went higher. So now what happened is you had a missed opportunity. Now the question you have to have is, why did you exit? Like, what happened? What are the comments? The comments on the trade for me is, I panicked because I saw a red candle. I panicked because I thought the stock was going to reverse. My emotion stepped in. I saw green, that I saw that I'm up $1,500, so I took the profits. I'm taking profits off too early. So that's something like I would comment on the trade. Now the only way I would actually know that is by going back. Guys, like, you must go back and understand the trade, right? Now, if you look at the overall rating, which once again I'll break down in the next video on how to use this, I gave it a C. Now, why did I give it a C? You might say, well, you made money. Guys, I've mentioned this before. Just because you make money on a trade, or just because you're green, does not mean that that is a good trade. And just because you're red on a trade does not mean that's a bad trade. So this trade, I did not give it a good rating because I obviously believe, hey, I gave it a bad rating. And obviously you can set this up in number terms, 1 through 5, 1 through 10, A, B, C, D, F, whatever, however you want to go about it, that's up to you. But I didn't give it a good rating. The reason I didn't give it a good rating, and that's where my comments would kick in, is because I took profits too early. I panicked. Obviously, I could have made a lot more money, but because of my emotions, because I overlooked something, I actually ended up, yes, making 1,500, but I could have potentially made 7,500 or 8,000 or 9,000. And that right there is already a $6,000 or $5K loss that I had to pay the price for because of my emotions, because of my lack of knowledge, because I was not able to follow my plan, right? So that itself, if you think about it, if this happens over a course of 10, 15, 20, 30 trades, that $5,000 number ends up becoming a lot larger. And yes, I've mentioned before, you shouldn't look at what you could have made, what you shouldn't have made, and all that stuff. But guys, you have to understand, mistakes like this are not good. Like, if you make this mistake once, cool, but if this is happening 20, 30 times over a course of a few trades, that's actually very, very bad at that point, right? Now, let's look at another trade, okay? Now, if you look at another trade right here, let's say I look at Apple, once again, call options, 252.5 strike. I entered at 10:12 a.m. My entry price was 312, 1,000 quantity, stop loss, profit target. What's my trade risk? How much am I willing or potentially looking to make, right? Now, when I look at my exit price was at 450. Now, this trade basically worked out accordingly to plan. Great. I sold at 450. Now, obviously, when we look at this, it's like, wow, I followed my plan. Everything looked good. But you as a trader should still go back to a situation like this and say, well, I sold at 450. I followed my plan. But now let me understand something. Was there an approach to maybe make more money on this trade? Could I have maybe made more? Could I have done something better? Some people might say, no, I followed my plan. The trade worked perfectly. I'm happy. Some people might say, when it went to 450, right, there was no reason for me to sell. I could have maybe taken half off and then let the other half ride out, right? And that's how some traders grow. Some traders might say, hey, I'm happy with my trade. I'm happy with the 1,300, so I'm good, right? So that's up to you on how you want to approach that situation. But I would still go back, review it, and see if I could have maybe made more money, maybe done something better, because the whole idea here, guys, is to constantly keep growing and becoming great traders. All right, so now let's look at another example. So here we're going to look at stock BYND. This is the date, 10/21/2019. Went long on the play. Entry time, entry price 101.20. What was the trade setup? Stop loss in 97.5. profit target at 110, risking about $370 to potentially make 880. Okay. Now, obviously, another thing I want to bring up, and I'll bring this up in the next video too, this is not going to be perfect at all times, guys. The idea here is to just have a plan and have kind of like a measuring stick, right? Just have that plan, have that measuring stick, and kind of take it from there. Now, when we go forward, you can see I entered at 1021, exited at 1022. And by the way, these are just made up trades, not real trades. I don't want anyone to think that these are actual trades right now. I will show you guys actual trades in part 12 and 13, but this is just to show you an example of the journal. Now you can see the exit point was at 10:22:19, 1:55 p.m. Now the timing is important because you guys want to go back and see why that exact time. What did you see? Maybe it was a candle. Maybe you saw something in price action. Whatever the case may be, maybe it was news. You want to really see that aspect and understand, right? Now, going forward, now you can take a look. The exit was a little bit different. There was two exits. One was at 92.8, 50 shares, and one was at 3 p.m., so about an hour later for 50 shares at a lower price. So the question here is, why did you only sell 50? Right? And then why did you wait about an hour to sell the remaining 50, right? Now, the other question is, okay, the trade didn't work out, you lost money. Now, like I mentioned, losing money is not a bad thing in the market, right? There's going to be times where you lose money, and that's okay. But the whole idea is to go back to the trade and understand a few set of concepts. Now, when I go back to this trade, I look at my exit point at 92.8 and 91.8. I'm like, okay, my stop loss was at 97.5. Okay, my stop loss, based off my stop loss, I was only supposed to lose $370. Now when I go to this trade, I lost $897, right? I lost about 2x more than I was originally going to lose if I followed my stop loss. Why did I lose more? Oh, I lost more because I obviously did not follow my stop loss. I did not follow my plan. Why did I not follow my plan? What changed? Why did I only sell 50 shares at 92.80 and then the remaining 50 at 91.80? Right? Maybe I panicked. Maybe I froze. Maybe I was hopeful. Right? These are things that you want to understand. Right? These are things you want to understand and you want to put in comments in your trade. What happened? Right? Like bad trade, why was it a bad trade? I didn't follow my plan, I didn't follow my stop loss, right? And these things are super important, guys, because once you consistently plug these numbers in and you start going back to your trades, and obviously you're not gonna realize it after 3 trades, but let's say you get to 50 trades or 60 trades or 70 trades. By the time you get to this number, you're gonna start seeing patterns here. You're going to see consistent patterns where you're making mistakes over and over and over again. And yes, no one wants to make mistakes. I understand. But listen, in trading, you're going to constantly make mistakes. And the idea is make the mistakes, but improve and get better. Improve and get better. Improve and get better. And each and every single time, your job as a trader is to consistently get better and better and better and better over time. And the only way, once again, you're going to do that is by going back to your trades, seeing what the patterns are, seeing where you're messing up. Why didn't you follow your stop loss? Now, once again, if you didn't follow your stop loss one time out of 50 trades, that's okay. It's going to happen. We're not perfect. But out of 50 losing trades, let's say you didn't follow your stop loss 39 times and you had a bigger than expected loss 39 times, that's going to cause a huge hit to your P&L. Which is why tracking these key metrics and understanding each and every single component is so important. Once again, it's so important, and I can't stress that enough. So make sure every single trade you take, guys, is tracked. And once again, the only way this is going to be helpful is when you use real money. On paper trading, this is not going to be helpful. It's not going to show you a lot. But on real money, that's where your emotions are going to kick in. That's where market makers are going to kick in. That's where it's going to become hard to get order fills and so on. So this is the journal, and this is what I want you guys to use to plug in each and every single one of your trades. So now, as a trader, what are some things you should look for? You should look for the following when you guys are tracking, right? In your KPI system, these are the things you guys should be looking for, what you should be focusing on each and every single trade. So obviously, number one, net profit. right? Do you have a profit? Do you have a loss? How much is it, right? Next thing, winning percentage and losing percentage, right? What is your winning percentage? What is your losing percentage, right? So if you're right on 5 trades, you're wrong on 5 trades out of 10 trades, right? Your winning and losing percentage is 50%, right? You want to track that. You want to see how many times are you right, how many times are you wrong. And tracking that is very, very important. Now, obviously, you're going to start getting better metrics once you start getting to like much more trades, maybe like 40 trades, 50 trades, and so on. The first few trades, everything's going to be rocky, but afterwards, that's where things are going to become a lot easier and you're going to see more information. Next thing you want to see is you want to see your largest winning trade and largest losing trade and understand the reason behind the largest winning trade, reason behind the largest losing trade, right? Let's say you have your largest winning trade is 5,000, but your average winning trades are 500. Now, why did you have such a massive increase in profits, right? It could be because you sized up a lot. Now, why did you size up a lot? Is that okay? Is that behavior that you should continue to keep doing, right? Maybe you had a great trade. What was the great trade? What was the setup, right? Or did you just get lucky? Or did you just gamble play something and it worked out? Right? You need to understand the reasoning behind every trade. Your losing trade, what was your largest losing trade? Let's say your largest losing trade was 7,000. Your average losers are 500. Why did you have a loss of 7,000? What is your largest winning trade? Your largest winning trade might be 2K. Now, if you have your largest winning trade at 2K and largest loser at 7, I'm telling you right now, there is a huge disconnect with the trading concept of having your emotions and the trading aspect in check, right? So there's probably a huge disconnect right there, okay? Obviously, you want to know your average winning and losing trades. You want to know your average hold time. How long are you holding certain trades? Now, this is important because let's say you take on 50 trades, you lost money on 30 of them. Now, if you lost money on 30 of them, you want to see which ones did you lose the most money on and really dig deep inside and understand. The 30 trades I lost money on, I held longer than 1 hour, right? The ones I held longer than 1 hour, I ended up losing a lot more because the stock was going against me and I just didn't cut my losses, so my losses were very, very increased as well. So I shouldn't be holding trades for a long period of time, especially if they're not working in my favor, right? Largest number of consecutive losses and wins, spelled that wrong, but largest number of consecutive losses and wins, right? Maybe you had a winning streak for 30 days. Maybe you had a losing streak for 80 days. Why was there a losing streak? Was it continued on from the prior week and so on? Why did you have a winning trade? What can you do again to continue this momentum or have this momentum again, right? These are things you want to understand so you can continuously either keep doing it or adjust and not make the same mistake over and over again. What is your maximum drawdown, right? What works and what doesn't? Like obviously when you track each trade, you want to know, hey, what has been working for me? When I day trade, I make most of my money. When I swing trade, I don't. When I scalp, I lose a lot of money because I can't trade on smaller time frames. I have an extremely hard time, right? What is your emotion walkthrough behind every single trade, right? Obviously, we're tracking emotions too. We're tracking how we're feeling before a trade we take. And as we're tracking that, we want to fully understand, like, hey, like what's going on, right? How are we feeling? Why are we doing what we're doing? Why did I take this big size trade? Usually I risk $200 on a trade, but this trade I risked $5,000. Oh, I risked $5,000 because I needed money this month to pay for rent. I needed money to buy this cool thing, and I took on more risk because I was like, if I take on more risk, I'll be able to purchase what I want or need, right? So obviously that's not a good thing, but you want to have a solid understanding behind each component. Next, do you hold on to losing positions longer than you should? Yes and no, and why? Right? You want to understand the why behind, like, this is like when you go through your KPIs, you want to like ask yourself these questions. Do you let winners run or take profits early? Right? Once again, let's say you take 50 trades, you're right on 20, and when you're right on 20, you kind of look into it. On all of them, I was supposed to make 500 on average on a trade, but my biggest profit was 70 bucks. But I was expected to make 500. What's the disconnect? Am I aiming too high or am I selling too early? How do I find that out? I go back to the chart that day, or that moment, and I see, was there a room to move up or move down, whatever the case is, and did I miss out on more money? Oh yeah, I did miss out on more money because I saw a little bit green. I saw it was up 70 and I kept taking it off the table, which is obviously hurting me in the long run. Next, what setup did you miss and not take, and why? Obviously, when you guys create setups, you want to understand like what setup did you miss? Like, why'd you miss it? Right? Let's say I'm saying, hey, I want to buy Apple above 220. Right? If Apple goes above $220 on a nice breakout, I'm looking to buy it. My question is going to be like, why did I miss this? Was I not focused on it? Did I forget about it? Why did I forget about it? Why didn't I take the trade? Maybe I was scared. Maybe it was in front of me and I was scared. Maybe I forgot about it. Maybe I just didn't want to trade it. Whatever reason it is, you want to understand this because this all relates to your emotions. It relates to your mindset. And then obviously why you didn't take it. Now, also, are you doing better some days than others? Like, you want to understand what days are you doing good on? What days are you doing bad? Right? So for example, as I mentioned before, let's say on Wednesday, right, you work a late night shift. Your late night shift ends at 4 a.m. Eastern Standard Time. Market opens at 9:30 a.m. Eastern Standard Time. So basically, when your shift ends, you go home and you sleep at 7, and then you wake up at 9 to trade. And then since you have very little sleep and you're all over the place, you rush to trade. Maybe sometimes on, let's say, Thursday, you have work at 11 a.m. or you have college at 11 a.m. Market opens at 9:30 a.m. Eastern Standard Time, and in your head, you start forcing trades because you're like, I only have an hour and a half window. So you start looking to forcefully trade, and what you see is on Thursdays, you usually have a red day or not the best day. Even if you're green, you just end up having a very bad day based on ratings, based on selling too early, based on not letting your stop loss kick in, or whatever the case is. You realize that these are not good days for you to trade. And obviously, what is the reason for that? The reason is because of these few factors. Next, what do you notice when you go back to your trades to review? Right? Do you notice any pattern? Are there any consecutive mistakes you're making, which could go back to days, like what days you're losing money, what times you're losing money? Are there any events that happen in your life that affect your trading? Maybe you make money when the market is going up or down, but when it's trending, you have a very hard time making money. The patterns you realize is you go on a great winning streak Monday through Thursday, and then Friday you give away all your profits, right? Or maybe you go on a bad losing streak Monday through Wednesday, and then the remaining 2 days you kind of break even. Why? Because you're forcing trades in the beginning of the week, right? So understanding this, guys, is very, very important. And these are questions you need to be asking yourself because, like I mentioned, the best trading book out there is your own. And if you look at this as a trading book and you have all of these numbers and facts down about yourself and about your trading, that itself is going to provide you a lot of feedback. And that feedback you can take and you can consistently work on, improve, and take it to another level, right? Now, last thing, compliance department. Now, what you have to do is you have to create basically a compliance department for yourself as a trader. Now, the idea of a compliance department is where you set up your weeks, your months, where you are scheduling a day where you review your trades, right? Now, the scheduling should be in two concepts, right? The first concept is weekly reviews, and the second concept is monthly reviews, which I'll get to in a minute. Now, in weekly reviews, what you're going to do is you're going to set out a day of the week, usually Sundays, where you recap your full trading week. So what I want you guys to do, and I'll break it down in the action item too, is time block, right? Take 2-3 hours on Sunday and time block your calendar. For example, say from like 5 p.m. to 8 p.m. Eastern Standard Time or wherever you are around the world, say you can't do anything, this is your job. You are required to show up, right? Go to Starbucks, go out, go somewhere else where you can actually focus, where you're going to plug in everything in your journal and review. You're going to go and say, how is the overall market? Like, you're going to look in these things because you want them to stick. How was the market this week? Was it up? Was it down? Was it sideways? Why? Like, you want to build consistently, and the only way you're going to do this is by reviewing and absorbing as much information as you possibly can. Next, what could you have done better? What needs improvement? right? Oh, I need to start waking up early. I wake up 10 minutes before the market, or I enter my trades too quick. I'm not patient enough, or I'm not taking profits, right, when I should. I'm not following my plan. What needs to improve on a weekly basis? Your trade recaps with the game plan and an aftermath. What was your game plan last Sunday for the following week? What did you follow? What didn't you follow, and why? Now, all the trades you took, what happened with them and why, right? If your plan was to enter a trade at 10 and exit at 14, right? And you exited in reality at 11, why did you exit at 11? What happened after you got out, right? These are things you need to ask yourself. And then obviously your mental state. What's your mental state that week? How is your mind? How are your emotions? Did you have a bad week? Maybe in your personal life, you're in college, you have midterms, maybe with something with family, maybe something with work, whatever the case is. Well, how is your mental state? Were you very stressed out, right? Because a lot of times when people are very stressed out and they have a lot of other things going on, that obviously affects the trading. So these are things you want to understand, and then you want to obviously go to your P&L and say, how is my P&L? There's going to be times where your mental state is phenomenal, your plans were great, everything was great, but you still had a red week. Now, that's not a bad week, guys. Just because you have a red week, that's not a bad week. As traders, you'll have red weeks, but green months. You'll have red months, but green years. So it's fine to have a bad day or a bad week, but the idea is to understand why. Was it in your control? And the only way you're going to do that is by creating a compliance department and reviewing each trade, even the trades you didn't take. Why didn't you take that? So set that up right now in your calendar where you're going to start reviewing your trades, and you have a set date, right? And then obviously you're going to do monthly review, schedule a day once a month to review your whole trading month. Now in this concept, what you're going to do is you're going to take all 4 or 5 weeks from here, and then you're going to combine it in this. All right, out of the past 4 or 5 weeks, I had 3 green weeks, 2 red weeks. I walked out making $8,000, right? What could I have done better, right? Why did I have 3 losing weeks? Oh, maybe I didn't see the market was reversing. Maybe the market was very choppy that week and I forced trades, right? You want to pick this up, because if you can pick it up, understand, and let's say it's August. Let's say you can pick it up and understand in August, you're maybe not going to make the same mistake in September. But if you just flow by and you don't pay attention to these key things, what's going to happen is the next month, you're going to start making the same mistake over and over and over again, and then you're just going to end up losing a lot of money. So it's very important for you as a trader to have this compliance department. Now, just to recap everything, guys, KPIs are super important. You want to look at key performance indicators of your trading performance. The whole idea of doing that is so you can consistently build as a trader. So make sure you journal every trade moving forward. Now, you're not only just going to journal, you're also going to review your trades. Don't just journal. Make sure you journal, review, refine, retune, and just go through a process of constant improvement. Now, in the next video, I'm going to break the journal down and show you how to fully effectively use it, and break down another journal as well, so you guys can have a good idea on how to actually use it and create your full week.